Hello, and thank you for joining us on this week's Market Carver. I am here joined by Zach. Adam is taking the week off, much needed break for him. And so we're very happy that Zach is joining me this week for the Market Carver. We have a lot to cover this week. Some pretty big topics we're going to talk about the equity market. We're going to talk about the housing market. And then Zach is going to dive into some of the things that are happening in interest rates and specifically on the fixed income, what's going on in the bond land. But first, let's talk about the equity market. As you know, if you've been watching the Market Carver for any period of time, that's what my biggest focus is as a technician, looking at what's changing in equity prices, and then always wanting to look under the hood and see if we're seeing the same type of movement as we see in the individual indices. Are we seeing that on the individual stock side? So we've had a really nice rally since last October. The market had that big bounce to finish out the year strong. And then we started January, had another really good, strong month in January for equities. And then when February rolled over, we started seeing stocks start to struggle. And we've given back about a third of the gains now. And so we want to start seeing, when we see the market begin to be put under pressure, start to decline, are we seeing a lot of selling internally? Are we seeing a lot of participation by individual stocks going lower? And so far, we're not seeing that yet. And hopefully that continues. But if we can see the declines that we saw at the end of the year, we look at the far right side of this chart. We saw the market dip in December, and then we saw it dip here in February. And what's important to recognize is that we're not seeing a lot of new 20-day lows, essentially 1 month lows made by individual stocks. This was something we saw quite often last year when the market was in that downtrend. We saw north of 50% of stocks were hitting new 20-day lows as we started to see expansion and bearish activity, a lot of downside moves in individual equities. That's not happening this time yet. The reason, the ultimate, what that tells us is that the market's being driven primarily by maybe just a handful of mega cap stocks. We've talked about that a lot last year. The Apples, Microsoft, Googles of the world are putting pressure on the indices, and that's what's caused the indices to drive lower. But we're not yet seeing a lot of individual equities drop. Instead, we are seeing levels of resistance that had been resistance last year hold up as support. We saw the smooth 200-day moving average, that blue line on this chart here. That was a really tough price level for the S&P 500 last year. And now we're seeing it actually draw in buyers acting as support, a very good change in character where we see resistance become support, a positive sign for equities, and hopefully that continues to hold. If it doesn't, then we'll have to reevaluate. But right now, we are seeing good levels of support hold up in the market. Now we're going to shift gears out of the equity market, look at some of the economics, and look at specifically the housing market. So as interest rates went higher last year, we really started seeing the housing market start to weaken, specifically not seeing a lot of buyers actually or sellers. A lot of people have stopped interested in selling their homes because they really wanted to latch on and hold on to maybe those lower interest rates they had on their mortgage. They saw interest rates were 6.5, 7%. And meanwhile, they might have already had a 3, 4% mortgage, and that was keeping them from wanting to sell. Meanwhile, we didn't have a lot of buyers either for similar reasons. They saw interest rates go higher and made it less incentivized to start looking to buy a new home. And with that, we can see that in the data. This chart here goes back to 1990 and looks at the number of U.S. mortgage applications to buy a home. And this rate has fallen drastically. We're now at the lowest level since 1995 in the number of mortgage applications being filed, kind of showing us the lack of buying activity in the real estate market. Now, this next chart, we can kind of see the reason why. This next chart's going to be looking at housing affordability. And because interest rates have gone up and we really haven't seen that big of a drop in housing prices, that's a tough equation for affordability. And so, in fact, housing affordability is the lowest it's been since 1986. One of the big drivers for the real estate market often is first-time home buyers. And they're very payment conscious because of they're really trying to tie that payment to what they're bringing in each month. And so they're very sensitive to the rise in interest rates that we've seen from the Fed hiking interest rates and that playing over into what we're seeing on the mortgage side. And so this is really starting to put some pressure on the housing market. And the reason we put a lot of focus on the housing market is it's a big part of the economy. It drives a lot of other industries outside of just housing prices, builders, consumer products, all the other things that are added on when you see the housing market improve or begin to weaken. And so we really pay a lot of attention to what goes on in housing. And right now it is under pressure. We're not seeing housing prices. They have come down, but not to the degree that you would expect based off a lot of the other data. So we're starting to continue to watch housing prices, continue to watch the housing market in general, and start seeing if it does begin to soften up or start to improve. But it's largely being driven by what's going on in the interest rates. And I'm going to turn it over to Zach, who's going to kind of continue that conversation, looking at interest rates and fixed income.
Yeah, so with interest rates rising most of last year and continuing to rise this year, we'll see a chart here that shows the year-to-date performance of the S&P 500 and then some individual segments within the bond market. So you got high yields and certain segments of treasuries with different maturities. And as Andrew mentioned at the top, we've seen some strength in equities there, which is that blue line at the bottom. But in late February and even early into March, you can see fixed income as a whole has gone negative as the fixed income market continues to kind of digest the potential for interest rates to continue rising. We saw some evidence of this, or heard some evidence of this, as Jerome Powell came out earlier this week and talked about how there may be a need to raise interest rates faster and to a higher number than previously thought due to some of the strength in economic activity. And that does pose a potential headwind for the fixed income market. And this is on the tail of a historically down year. Now, this doesn't mean that as a whole that fixed income is bad and that we should stay away from it, but rather it just signals that there's even more of a reason to take an active approach to fixed income, to manage where we're getting fixed income exposure as it relates to credit type and duration, whether we like high yields or treasuries, things of that nature, and which is why FEG takes an active approach in the fixed income segment to sort of manage some of that risk. And so we'll continue to keep an eye on the fixed income market moving forward. We expect that the active management of fixed income will help the portfolios.
Very good. Thank you, Zach. As he said, fixed income's still a topic today. It was a big topic last year. And as the Fed continues to adjust and try to fight inflation going into 2023, it's going to continue to be a topic we are discussing quite a bit in our allocation meeting and within our allocation discussions with how to best position our portfolios, your portfolios, and our models in the fixed income market. So we thank you very much for joining us this week. As always, if you'd like to schedule a call, you're happy to scan that QR code or give that number you see on your screen a call. We're happy to set up a meeting with one of our advisors and discuss how best we can serve you. Thank you very much. Have a great week, and we look forward to talking with you again next week.